like from here on. Let's get in. Vinay, Jaising, CIO and Head Equity Advisory at Ask Private Wealth. Vinay, good morning and welcome to the show. Always a pleasure to speak to you. This is Hiral on this side. You know, I mean, the way everyone was reading markets right now is that probably the ceasefire would briefly lift the sentiment. That's exactly how it played out in yesterday's session. Some profit booking coming in terms of today's session. With that, you had the RBI, which has maintained a status quo. You know, we were just having a chat with Samir Arora as well some time ago, and where he's indicating that the FI pressure in terms of selling has slightly abated. It's much better as compared to what we've seen in the past. If you have to put all of this together, you know, how are you looking at in terms of markets and India?
So a couple of things, you know, first, crude oil prices did correct a bit, but it's again firming up. That's not a good sign. You know, 93, 94 going to 96, 97 is way above, I would say, a normal $70 a barrel. So that's, you know, one pain point for the country. DXY still at 9,900 levels are very strong, which means the dollar is still firming up versus other countries in emerging market, and that is a negative correlation. Third, if you look at last month, you know, we had about $12.7 billion of outflow of FIIs, and you had $15 to $15.5 billion of DII money, which more than balanced it. But how did we get this $15 to $15.5 billion of money? We'll come to know in the next couple of days. It cannot be just SIP or insurance companies. There would have been a cash drawdown. And, you know, the cash with mutual funds, which have had about 5.9%, could have gone down by even as much as 1%. So, you know, you're going to a wafer thin level of cash treasure, which you have, you know, which is sinking quickly. So, you know, you need FIIs to start stably looking at India. The currency, you know, just repeating, Indian currency is the worst performing currency in the last year, gone down by 11 to 12%. Sure, it's not at 94, 94.5, but even at 92.6, it's not a great thing. Simply put, oil and gas prices still they are high. India imports as much as 5 million barrels per day of oil. So if oil is $40 above supernormal levels, you're spending $200 million on a daily basis additional of outflows of the dollar going out of the country. So these are signs which will, when the ceasefire becomes actual no fire, will stabilize. A very early days for us to say that things have gone back to normalcy, but yes, it's a step one. The quarterly results which should come out would be more rhetoric, you know, to be more dealing with the past, so people will be a lot more pleased in the quarterly results for India, because you've already seen the loan book growth, which has been robust for the financial sector. So apart from the bond yield pain, because, you know, bond yields would have moved up, so there may be mark-to-market some losses which the banks may show. But apart from that, you may see a 8-10% earnings growth on a year-on-year basis, and some signs that things were getting back to normal. But that was for Jan and Feb. So, you know, put subtly, the market index levels are very good. Large cap are at about 1 standard deviation below their peak. Mid cap are at virtually at average levels, and the small cap is a little above their average levels. So, you know, valuations are attractive, but so also the valuations of MSCI emerging market. You need the war to stop and the currency to stabilize. Earnings itself will come to the picture. So we are relatively a lot more constructive with the ceasefire part, but, you know, we're being very selective in what we are buying, because clearly stocks, there are many stocks which are below, you know, their average levels, and those are the ones we want to buy. And so it's not, you know, buying a sector, it's buying more so bottom-up picking on stocks where we think there's corrections and good long-term stories.
Okay, so we'll get into some of those stories, Vinay. I'm just weighing in perhaps on what you were talking about with regard to the flows. I'm curious about what you have to think, because what I've heard is that the SIP number is going to take a little bit of a tumble. Because you've seen a little bit of stoppage take place in the month gone by, but the net and the gross numbers are going to look healthy at the end of the quarter and the year. But having said that, I also want to know what you think about the size of the balanced advantage funds and the other hybrid funds multi-asset as well, because the largest in the balanced advantage category is now, what, 85,000 crore rupees. And so the ability to reallocate from a fixed income to equity also takes place. And so therefore, that to a certain extent can explain some of the flows into equity.
You're absolutely right, right? I'm hoping what you're saying is right. And, you're getting multi-asset funds putting in more money into equity because the markets are cheaper and, the debt yields are not as interesting as they were. So that's one part of it. But, a $15 billion inflow for DIIs into the market last month cannot be explained even with multi-asset funds getting into the country, but for cash levels dipping, in my eyes, for the mutual fund space. So I think it'll be a little bit of all three. It'll be a little bit of SIP data, as you rightly put it, 298 to 300 billion. It'll more or less be at that levels. It won't be substantially high. So that's about $3.2 billion. You could see another $2 billion, from the comment you made on multi-asset funds coming in, or maybe even three. But what about the remaining $6 billion? How much of that could come from insurance? My bet is there could be at least a $3 billion cash, which has come down from the mutual funds, or 0.5%, at least, 5.9 going to 5.15% levels as far as cash positions of DI are concerned. That for me is a bit concerning. And I'm hoping that, FIs outflow just stops. Even if they don't buy into the country, I think you would see DIs put in as much as $100 billion in the next year, up from 90 last year, which is a magnificent number.
Yeah.
And IPOs, you didn't allude to the last part. You didn't have many IPOs last month, thank God.
Thank
money
God
goes
for that.
there as well.
And what we're hearing actually is that a lot of these entities are pushing it down the road, right? Because the conditions obviously are not as conducive. But Vinay, just to that point, am I right in therefore interpreting what you're saying as perhaps a little bit of fatigue that might creep in the next couple of months if the selling continues? And even in a market like yesterday, where everything gained, you still had a net negative number of over 2,800 crore rupees in the cash market by foreign institutional investors. Yes, they didn't sell 8,000 crore rupees, but they still sold 2,800 crore. You have to have that absorption.
That's exactly my fear, right? My fear is if you look at India, if it's the worst performing currency, it's a non-AI market. And then you have Korea and Taiwan, which are largely AI markets just because of the indice constituents of, the two big companies there, TSMC and Samsung. There's always a debate for an FI saying that, yes, India's got cheaper, but let's see what's happening to the crude front. What if the forex reserves keep on going down for the country? Let's put in money in a more stable currency environment where there's an AI story, and you could just see flows moving out, which has been the case for a lot of last year. So you need DII money to control the market. And yesterday was case in point. But I think if oil goes below $80, $85, that story can change very quickly. So a lot of this depends on whether ceasefire is equal to actual ceasefire, war being behind us, and crude oil. And we are focusing so much on crude oil. But remember, gas prices are up 60 to 70%. Even today, the spot market gas prices have moved up from $10 per MMBTU to 16, 17. They were up to 19. And these prices of gas don't move very quickly. So both of them are hurting India for sure.
Now, Vinay, the question therefore comes to mind is that if not market-wide, Nifty-wide valuations, are pockets or sectors or themes or bottom-up valuations do bake that and potential future stresses in right now as the situation stands. Crude at 150 is a separate kettle of fish altogether. But as things stand, do some sectors offer you that opportunity?
I think the answer is yes. More than sectors, many companies offer you the opportunity. If you look at something in the private banking sector, just because they've been hammered so much in the last year and their valuations are way, more than one standard deviation below their peak, they give you valuation. If you look at telecom companies, maybe company, you've seen huge growth numbers coming in because ARPUs remain low. You're looking at a listing of Jio coming, which means, you're having a very stable situation. And then there's the AI play for them, which will also come into the picture. So you've got something coming in there. Even if you look at IT companies, TCS results are coming out today, and looking at analyst estimates, they're talking about 2% YOY, but because of the rupee gain, you may see the bottom line grow higher than 10% year on year. So the IT Nifty, IT ETF has corrected by as much as 20% in the last year. That's a lot more than what you'll see in as far as earnings are concerned. So there are many sockets. I didn't mention the capital good names, which are more domestic stories, wherein again you've got a huge positive coming in, largely because the government capex has not yet slowed down. Can it slow down because of excise duty, cuts which have happened in the oil and gas sector of as much as 0.4% of the country's GDP or 1.7 trillion? Yes, it can, but it hasn't slowed down now. And you will see a lot of stories, on bottom-up analysis on capex and cement companies also being a lot more better. So yes, lots of sectors and lots of ideas which have corrected a lot. Here, the fear, Neeraj, for me is a lot more on the technical parameters of these companies. If a FI is looking to sell and does not look at the company it's selling, you can see some pressures in some of these stocks, and these are opportunities for us to buy them for the medium to longer term.
Got it. And Vinay, there are some sectors which by definition are not present in the large cap arena, right? Are there pockets in those where you find favor, or currently you would want the large caps, because even if the FIs were to come back, they'll come back first in the large caps, then go to the mid caps, and then go to the small caps?
I firmly believe it may be the opposite, right? Because
okay,
today the definition of large cap is the same as it was 10, 20 years ago, which is the top 100 companies. In today, if you have more than $500 billion companies, $501 billion companies, you've got 250 of them in small and 150 of them in mid. So for me, mid and small, there's been good corrections. There are many stocks which have corrected, and they are the best in class in terms of growth. So for me, that part of the portfolio would be a substantial part of it, maybe 50%, give or take, change in today's environment. But large cap, just because of their correction and their valuation, would also be a strong position. So for me, it's kind of a seesaw, wherein you're using a barbell strategy, wherein, large cap, the ones which have corrected robust earnings growth in the next 2-3 years, look at them and, at least have 40 to 50% of that in your portfolio. And then look at mid and small and fill in the rest, because you kind of balance yourself from what FIs may buy in the large cap names, and more importantly, the winners in small and mid, which are tomorrow's large cap names, which you've already identified, which have had, some supply constraints, courtesy Israel or State of Hormuz, which can be sold very, very quickly, or some constraints wherein you can't give your export orders as quickly because of shipping to the other parts of the world or global exports slowing down. So that will give you a bigger pie and alpha into your portfolio. So that's very important for me to get right.
Okay, so that's, when it comes to identifying pockets. However, Vinay, if you have to look at individual sectors, let's talk about IT. That is one of the sectors which has now come to the forefront with TCS, that will be reporting numbers from today. But how are you looking at the entire pack right now in terms of IT? The AI play that does come in, because the question then is, when does AI actually start generating revenues at scale for all of these IT majors? And is it that the broader market IT players are better placed as an AI bet versus the large caps currently?
It's an amazing question. Our team has done a lot of work on AI in the country, and more importantly, the picks and shovels of AI, which go to give you raw material, or should I call it capital goods, for the rest of the world. So let's look at both these and also take your question on IT. IT per se is not going to get more than a 10% contribution as a sector from AI in the next 2-3 years. It's going to take a long time for that to happen. It's not like how digital and conventional business model for IT changed in 4-5 years, and now virtually everything is digital as a part of the total pie. In the case of AI, you will see the digital part of the revenue story slow down, and you'll see the AI part grow. But it's a 3, 4, 5 year phase, and 10% in the next 2, 3 years is a good number. You have to look at contributions coming in from IT, coming in from AI for the IT space. They will gain in the shorter term more so because there's no disruption on AI for their business as much as people believe, and actually they are helping build the ecosystem for AI for services for the enterprises. And the dollar, please remember, is today at 92, 93, not at 82, 83. So they're going to gain for multiple of other reasons. We were virtually underweight to non-existent in IT earlier. We're still underweight, but we've increased our position in IT because we've got some 5-6% dividend yield stocks and 1-2 names in IT which are little more than, as I said, 10% in the AI part of the story. But on your second part, when you're looking at AI spend in the country, we are today at about 1.3, 1.4 gigawatts of data capacity for the country. That number is going to go to 8 gigawatts in the next 4 to 5 years, right? Which means you'll have something close to $700 to $750 billion of capex spend in the country. 500 could be for GPUs, but the other $200 billion will be going to the picks and shovels of companies which are into generators, companies which are making hot boxes for energy companies globally and domestically, companies which are purely making power and green energy, cooling systems. You've got an entire ecosystem growth which will come up because of the data centers coming up into the country. And those are the names you should look at a lot more aggressively. And obviously the telecom names, which are, the leading data centers of the country. You've got 1-2 data center enablers also. These are the names you've got to look at. If they have a strong balance sheet and they've got tie-ups with hyperscalers, it's going to be tick the box for you. So that's a new segment which India Inc. is not yet used to, investing into, nor are the earnings as clear. Let me just give you 1 point more out here. Sorry, long answer. ChatGPT came out in 2022, October, November. If you look at 2022 to date, the Magnificent Seven were 20% of market cap in 2022. Today, they are 36% of the market cap of US. That tells you what happens both to the earnings growth trajectory as well as to the growth when AI comes into your country. That may be a little long stretch for India, but the capex cycle for data centers are going to hit us very soon. So let's take advantage of those names.
Well, hopefully the markets give us enough opportunities to take advantage within specific themes or otherwise. But Vinay, such a pleasure talking to you today. Thanks so much for taking the time out and being with us.
Appreciate your time, guys.
Well, the markets, though, on their part,